Greetings, team. Happy Aloha Friday before Labor Day weekend. My name is David Merrill, call sign Sandy, and welcome everyone to today's Lunchtime Snacks and Facts Continuous Learning session. Special thanks to Dr. Shriver, who will be my over-instruct for this training. We're going to spend the next few minutes talking about sensitivity analysis as a tool for capital budgeting. This week's session is designed to give you practical takeaways you can apply back to your desk. If you couldn't join us live, don't worry, this is being recorded so you can review it later or share with colleagues who might find it useful. I'll post the link to the video on the title slide of the shared presentation. My goal today is to explain how sensitivity analysis works, why it matters, and how both quantitative and qualitative factors shape better financial decisions. We'll connect this to capital budgeting, which is an important tool for evaluating investments, whether that be in small business or multinational corporations. We're diving into sensitivity analysis. Let's anchor ourselves in the basics. The goal of financial management is simple: maximize value while managing risk. To do this, we allocate resources efficiently, maintain liquidity, and make investments in financial solutions that support long-term sustainability. Sensitivity analysis is one of those tools that helps us test our assumptions and ensure we're making sound decisions. At its core, sensitivity analysis answers what-if questions. For example, what if sales drop 10%? What if interest rate goes up? After identifying critical variables, we can tweak them in simulations one at a time and see how outcomes like net present value, NPV, or internal rate of return, IRR, shift. It's a powerful way to identify which assumptions matter more and where our biggest risks dwell. This makes it a critical step in planning for uncertainty rather than delaying on a single forecast, rather than relying on a single forecast from our financial analysis team. Quantitative analysis gives us the numbers. Here's what that looks like: adjusting inputs like sales volume, costs, or discount rates, running Excel models to simulate multiple scenarios, adjusting one variable at a time while holding others constant to see the impact, and comparing outputs like NPV, IRR, and payback period methods. This is where spreadsheets shine because you can quickly see the ripple effect of small changes in your assumptions. It's better than working on these equations over and over again by hand. This approach via spreadsheet or model is powerful because it isolates which assumptions have the greatest effect on profitability and helps prioritize monetizing those factors. Those numbers don't tell the whole story. We also need to factor in qualitative inputs, leadership quality, and team experience. Mr. Rob, I didn't see you in the participants list, but if you're watching this, we love you. And we all know our company has frequent turnover with changing government policies, but we'll deep dive that in a later Snacks and Facts session hosted by our HR team. We also have to consider brand strength and customer loyalty and regulatory and political environments. These soft elements often explain why two projects with the same financials can carry very different risk policies. A project that looks good on paper could be derailed by a new law passing or supply chain disruption. Combining qualitative and quantitative analysis makes decisions more realistic. This integration is essential for project managers balancing both data and context. Let's talk about risk. Starting inside the company, internal risks include employee turnover or weak management, which we touched on a little earlier, ineffective operations and delays in the sense of complacency or slow pace processing of routine matters. How long has that report been sitting on your desk? Are we too comfortable and don't take the risks that could result in profits? Over reliance on debt financing. While it creates leverage, the need to liquidate assets to balance our capital is always looming. In scenario planning, testing our models with known variables of expected or forecasted changes. The good news, the risks are more controllable. Sensitivity analysis helps test internal assumptions like what happens if production efficiency is lower than expected. About stress testing what we can manage. Next, the risks you cannot control. External risks include changes in market demand, like trends. Who bought a Labubu? My nieces were obsessed. Well, at least they were. But I can't really talk. I definitely have a few boxes of Beanie Babies and Pokemon cards in my garage. Uh, there's there's also currency fluctuations over multinational projects, the national currency exchange with with their international partners, and interest rates hikes in inflation. These can't be eliminated, but by modeling them in sensitivity analysis, you can navigate those uncertainties by preparing contingency plans instead of getting caught off guard. Effective financial systems must provide a framework to transfer resources and manage risks across time and markets. Finally, let's connect risk to techniques. To handle uncertainty, we can use scenario analysis to combine multiple variables, apply simulations like Monte Carlo modeling for probabilities, adjust discount rates for projects with high risk. Together with sensitivity analysis, these tools give leaders the confidence to make decisions under uncertainty rather than guessing. Let's walk through an example. The company considers launching a new product. By flexing sales forecasts and interest rates, management identifies the breaking points where NPV turns negative. These results are informative not just for go, no go criteria, but also allows for contingency planning. To wrap it up, sensitivity analysis allows managers to test how changes and assumptions affect project outcomes. By blending quantitative models with qualitative insights, companies can make better informed capital budgeting decisions. Whether you're an entrepreneur starting a small or a global corporation managing billions of dollars, the principle is the same. Capital structure and risk management matter. Here are the references I used to prepare this presentation, all of which shape today's discussion. I hope you enjoyed this week's Snacks and Facts session. I'll stick around for questions or send them my way via email. For those at HQ, don't forget, Cheat Day Food Truck is outside the gym next door. I heard they're giving out free samples to test out a new recipe. Have a great day and a great weekend, and cheers.